Okay, good morning. Today we're going to be talking about the inventory, finishing up the chapter, and I want to talk about learning catalytics. So the reason I want to talk about today, we are, and many days in the future, we are going to be doing learning catalytics for accuracy. And the accuracy will be based 50% on participation and 50% on accuracy. You'll earn 50% simply for getting every question wrong, and then you'll earn the other 50% based on accuracy. For example, if we have 10 questions, I have no idea how many questions we're going to have today or any day. If we have 10 questions, you answer all 10 and you get 8 of them correct, your score will be 90% because you get 50% of your credit is times 10 out of 10, and then 50% of your credit is 8 out of 10. So you get a 90%. So if you get one wrong, it's not the end of the world. That said, today, for example, you should be, if you're paying attention and taking notes, you should absolutely be fine on every question today. I would expect 100% score, and that would be very achievable. It's not going to be anything hard. We're going to go over the question content before we have the question, so you should be pretty well prepared. This isn't something to get nervous about. Okay, so here's the deal. I'm going to tell you why we're doing this. I always plan to go to accuracy-based. I wanted to give everyone a chance to get comfortable using learning catalytics. The reason we have learning catalytics is because I want you to engage with the material. I want you to try it. I want you to really commit to an answer and think about what that answer is. The only way you're going to learn accounting is actually by applying it and by trying it. I can stand up here and make it look really easy, and then you're not going to remember as much as you would if you get to try a question. So for a lot of students, doing the participation model will be fine because you can enter your answer and you try it. But there's a significant number now, and it's getting higher every week, of students who aren't trying, who are answering anything. We saw that on Monday. I've kind of been watching this over the last few weeks, but on Monday I gave the correct answer, and I believe only 85% of students got it right when the right answer is on the screen. So that's telling me we're just entering anything. And there was another question where I asked you for how many units, and several people entered nonsense answers like X or Y or Z, and so really not even trying the content. So I want you to try it. I want you to be successful in this class. I want people to pass the class, and part of that is getting you to do it. You're here with me for an hour and 15 minutes. I want you to fully participate. This learning catalytics, it's not meant to be a penalty. Just see, today it will be fine. It will work out, but I want you to try the content. So that's why we are doing this. No, Monday, I'm going to get that because I know that. No, Monday had nothing to do with being able to get online. If you can't get online, you can always contact Blackboard Tech Support. Monday, the reason our recordings from Monday are called orphaned recordings. Blackboard did an upgrade over the weekend, and the sessions that were recorded first thing Monday got what they called orphaned, and so they're off in limbo land somewhere. So they might appear, they might not. But that doesn't have anything to do with it. But anyways, yeah, and that person can't hear me, so I'm talking for no reason, right? So doesn't have any audio, so okay. Anyways, you deal with that. I'm done with that. Okay, so accuracy-based today and probably into the foreseeable future. Just you should always answer questions to the best of your ability anyway, so it shouldn't matter how we're grading. Okay, so homework. Chapter 6 is due this weekend. I will have this inventory chapter is pretty, to me it's pretty fun, but it is definitely different from anything you've done before. So once again, I have recorded step-by-step videos to cover any of the homework problems we don't do in class, which will be a fair number, because I wanted class to focus on those basic fundamentals. Okay, so inventory and cost of goods sold. So our basic inventory formulas would be the beginning inventory plus purchases equals available for sale minus ending inventory gives us a number of units sold. We can flip the last two things, those formulas we had on Monday. So you just want to make sure that you know those formulas. I'm going to give you those formulas on your exam equation sheet, but those are fundamental to whatever we're doing in this chapter. So for example, we have the lower right-hand corner, beginning inventory plus purchases. That makes sense. What we started with plus what we purchased, then we subtract what we sold, that gives us how many we have left. And we can do the opposite as well. So those are not anything new that relates to Monday. Okay, so that said, you have a question in Learning Catalytics right now that is based, and if it looks familiar, absolutely it is familiar. It's from Monday. So we would have done this question that's in Learning Catalytics right now. Beginning inventory is 10 units. 6 units were purchased during the period, and 2 units were sold. How many units are in ending inventory? So those basic formulas that we did on Monday, actually we did this exact question. How many units are in ending inventory? So you know what you started with, you know what you purchased, you know how many you sold. So enter your answer. It's just this isn't in dollars or anything, it's just a number. 97% correct, good. That's what I'd like to see, 100% correct. Okay. So you should be good on this one. Again, beginning inventory, 10 units, 6 units purchased, and then you have, it's telling you have 2 units sold, so what's in ending inventory? We're going to close this in about 5 seconds or so. Okay, and the answer is 14. Okay, so you take your beginning inventory plus your purchases less sold gives you ending inventory. Okay, so that's kind of a review. That fundamental, being able to figure out how many units are sold or how many are ending inventory, you absolutely need to be able to do that in this chapter. Okay, so now we're going to start some of the newer stuff and some of the blending stuff. So inventory is an asset. Cost of goods sold is an expense. Okay, so inventory is an asset. It's on the balance sheet. It's a current asset. We're going to see this coming up next. Cost of goods sold is an expense. It's one of the only expense accounts that doesn't have the word expense in it. Okay. So inventory is an asset, current asset, and cost of goods sold is an expense. We're going to see that coming up here. This is Exhibit 6.2 in your book. The first part of this, the first box here, is a balance sheet. And when we talk about what's important on here, this is our balance sheet, partial balance sheet. And we see that we have current assets. Current assets, the first one listed, it's always going to be cash, then usually short-term investments, accounts receivable, and then we see inventory. So it's in our current assets. It's not one of the top ones, not one of the most liquid ones, but it's there. And then a partial income statement down here, we're going to see cost of goods sold is an expense that's deducted from sales revenue. And we get something, after we take our sales revenue minus cost of goods sold, we get a gross profit. So we're going to see that coming up here again in a little bit, but inventory is an asset, it's a current asset, and cost of goods sold is an expense on the income statement. Okay, we have 2 prices or 2 costs associated, 2 dollar figures associated with each piece of inventory. The first one is the sales price. And the sales price is the selling price. So we might refer to it as selling price or sales price. So what you need to record here, okay, the sales price, the sales revenue is the only one that is based on the selling price. So sales revenue is based on the selling price. So we might call that sales revenue, we might call it sales price or selling price. That's what we charge the customer. So if we're Family Dollar store and we're selling towels for $5, customers pay $5 for the towel, the sales revenue is based on the $5 selling price. Now, the cost of the towels, let's say Family Dollar store buys the towels for $3. The cost is what shows up in cost of goods sold. So this cost of goods sold is based on the cost of inventory sold. This formula is less useful than you would want it to be, so it's only going to work if we're using the average price method. So this one is not as useful. We'll review how to do inventory again. Cost of goods sold will work if you have one cost. Inventory on the balance sheet is based on the cost of inventory. So we have the cost. So Family Dollar store selling the towels for $5, the $5 goes on the income statement under sales revenue, but then the $3 is going to show up in cost of goods sold and on the balance sheet. Okay, so our cost is what the inventory is valued at. Our cost is what the cost of goods sold is valued at. Selling price, the customer selling price, is only on the income statement as sales revenue. Okay. Now, so we have the sales price, selling price versus the cost. So you have to know which one's which. The only place that you use selling price is on sales revenue on the income statement. Cost of goods sold and inventory are both at cost. Okay, now a couple more terms on here. The number of units in inventory, that's determined from the accounting records. We keep track, right? We know how many we started with. We buy more. We know we have more. We sell some. They go away. So we know how many we have in the accounting records. Even though we do that, we have to have a physical count at the end of the year. That's to make sure that we've recorded things properly and that we account for any inventory shrinkage. So things like inventory being shoplifted, unfortunately, or if it breaks or something and it's discarded. So we have to account for that as well. We have another term here, consigned goods, goods on consignment. Okay. Okay, goods on consignment. Consigned goods are on the balance sheet in the inventory of the company that owns them. Let's go through an example. There's a shop downtown Kent called McKay Bricker. And in there, I went in there this fall, and they had these little statues of black squirrels. So I wanted to buy one. So I went to buy one, and the lady said, oh, that goes in a separate, the money that I paid her, she said, oh, that goes in a separate place because we don't own those. The university owns them. And here the bookstore here gives different merchants these squirrels to sell. And so the bookstore still owns the squirrel. Bricker McKay did not buy the squirrel. So then the Bricker McKay would give the money to the bookstore once they sold the squirrel to me. And then presumably the bookstore gives Bricker McKay some kind of commission on that. But those goods, those black squirrels that are out in the community, the university owns or the bookstore owns those. Those squirrels would be on the bookstore's inventory. Bricker McKay does not have those squirrels in its inventory because it doesn't own them and it doesn't have title to them. They're just in its shop. So goods that are on consignment, it's who owns them is where the inventory goes on the balance sheet. Okay, in-transit goods. These are, you shipped it, when does title transfer? That goes back to FOB shipping point or FOB destination. So you would, FOB shipping point, title transfers when it leaves the seller's dock. FOB destination, the inventory isn't owned by the buyer until it reaches the destination. Okay, so now we have another question coming up. Okay, inventory is presented on the balance sheet at the selling price of the item. True or false? And just go back a little ways in your notes because we just talked about this. Once again, when we talked about this a couple slides ago, we talked about the selling price. The selling price of the item is used to record sales revenue, and that would be the only place it would be used. We're going to close this in about 10 seconds. Okay, and that would be false because we record it at the cost of the item. Okay, so we had the cost of the item is going to be inventory on the balance sheet, cost of goods sold on the income statement. The only time you're going to use selling price is going to be on the income statement under sales revenue. Okay, we did the basic inventory formulas. You had those, we started class. Just make sure in the lower left-hand corner, beginning inventory plus purchases always has to equal ending inventory plus cost of goods sold. Now we have another vocabulary term, two vocabulary terms coming up here. This is perpetual inventory system and periodic. So, perpetual inventory system, this is the biggie. The big thing you need to know about perpetual inventory system is perpetual inventory keeps a running total of everything. So you always know at any given time how much inventory you have. So this perpetual inventory system is used for all types of goods. It keeps a running record of everything bought, sold, and on hand. And under perpetual inventory, you're still going to count inventory at least once a year. Perpetual inventory is typically computerized. When you go into Giant Eagle, and they instituted a policy change a couple of years ago at Giant Eagle. Before then, you could go into Giant Eagle and say you bought 20 cans of cat food, okay? And you buy all the different varieties. So you have these 20 cans, and a couple of years ago when you went into Giant Eagle, you could just stack the cans there. The cashier would grab one of the cans, scan it, and put times 20, okay, and be done with it. Well, then they changed their policy, so now the cashier has to scan each one of those individual cans. And why is that? Because Giant Eagle has a perpetual inventory system where they're keeping track of how much of each of those types, those different flavors, because they order by the case of different flavors. So they need to know how many they have on hand. And when you do that 1 can times 20, it's going to take all 20 out of that 1 can's variety, and then your inventory is going to be off across the board. So that's why stores like that want to scan each individual item so that their inventory records are correct. But you can imagine that still happens sometimes. I notice it that once in a while they'll override it and they'll do it to save time. So you can imagine at the end of the year, they're having to do inventory. They have to reconcile their records for errors like that, where they've recorded the wrong thing, or for inventory shrinkage caused by shoplifters or things that break. Okay, so you drop a jar of spaghetti sauce. There's something that needs to go out of inventory. I doubt that the person cleaning it up runs and writes a journal, has a journal entry generated for that. So they still have to do a physical count, but the big thing to know in your notes, you should have perpetual equals running total or running record, okay? Yes. So we have Tyler. Actually, I have a Best Buy example coming up here. I work at Best Buy, and every year we have to do something called physical inventory, where we have to hand count everything in our stores. It takes a long time. Do you do that at Best Buy's year end? Because if I noticed that Giant Eagle uses the Regis inventory service, and there's little yellow tags once a year all over the shelves, and that's what they're doing. September, quarter 3 usually. Okay, so they do a physical count. Companies do a physical count at least once a year. It is very time consuming. At the company, I worked at Plastic Lumber, and we had a calendar year end, so our year end was December 31st. So we joked that until I left Plastic Lumber, I spent New Year's Eve doing inventory counts. So it's not fun to be an accountant on New Year's Eve or New Year's Day sometimes when you get stuck with inventory counts. So Best Buy is doing it smarter than we did, that you do it a different time of the year. Okay, yes, we use the yellow tickets. Yeah. So Mark does that. Yeah, so if you work in retail, you're probably familiar with the dreaded inventory count, what you're doing. Yes. Yes, you work at AT&T. Mm-hmm. Phone inventory every day. Yes, you have to split 4 of each phone. Yes, you are absolutely at AT&T using the perpetual inventory system. And probably most likely, so when you scan each one, that's keeping the computer records straight, but you have to count inventory at every night? Yeah. Okay, I suspect that the reason you have to count inventory at every night is an internal control. We're going to talk about those in a later chapter, where that's a control because your inventory is very desirable, it's very small, it's very easy to walk out the door, it's high cost, so that's probably a control that's in place. But yeah, every time you scan it is you're updating perpetual records. What's TXRH? Should I know this? Okay. We'll talk about tax later. Okay. Texas Roadhouse. Okay. I'm not going to, yeah. Okay. So we can get sidetracked really easily here. Have a lot of good things here. Okay. So then periodic inventory system. You can only use periodic if you don't have that much inventory and you don't need a count of it very frequently. This is just used for something inexpensive, incidental, and you count the inventory at least once a year. Let's say you're a landscaping firm, and one of the things you do is you keep landscape light bulbs in stock on the truck. So if you're going somewhere, you could replace a bulb if it's broken or something. So you wouldn't scan those every time you use it. They're pretty inexpensive. So at the end of the year, well, you know how much you've purchased during the year. So at the end of the year, you open up the truck, you see how many bulbs you have left. So that's your ending inventory, and then you can write a journal. So you're not going to be able to use periodic for very much. Most companies are using perpetual inventory. Okay, so now, cost of your inventory. The cost of your inventory is the cost, what it costs you, so the invoice, the purchase price of the inventory, plus some other costs. This is not a complete list. There's a few other things that will go on this list. But freight in. Freight in is the cost of getting the inventory to you. So you purchase it, you have to pay shipping to get it to you. That's part of the cost of the inventory, so you would add that in. And then purchase returns. This is if you buy something, you being the company, you buy something and you return it, you subtract that from your purchases. Purchase allowances. This is you buy something, it's got a dent in it, So you call the company and they'll say, well, if you keep it, we'll give you $100 off or something. Okay. And then purchase discounts. This is where you purchase something, maybe a 210 net 30 discount. So we talked about the purchase discounts, purchase allowances, purchase returns. We talked about that in accounts receivable. We talked about sales discounts, sales allowances, and sales returns. This is just the mirror image. So when we talk about our net cost of our inventory, it's the purchase price of inventory plus the freight in minus those purchase allowance, returns, and discounts. You would also, if you have to pay tax on any inventory when you buy it, that's added to the cost of the inventory. If you have to pay any import duties, that's added to the cost of the inventory. Okay, so we're going to do, there are 3 basic journals that we need to know when we're talking about this perpetual inventory system. Okay, the first one, we can record, let's say we buy $1,000 worth of merchandise on account. So to record that $1,000 of inventory when we purchase it, we're going to debit inventory, which is an asset, and we're going to credit accounts payable, which is a liability. So we're increasing assets, we're increasing liabilities when we purchase inventory on account. We should make a note. Let's look up 10Ks for AT&T and make a note about Texas Roadhouse because I don't know if it's publicly held, but if it is, we'll use that. And Marks, let's look at, I don't know if they're publicly held. Okay, so we buy inventory on account. We're going to debit account, inventory. We've got our asset increasing. We're going to credit accounts payable. Okay, now if we buy something on account, we have to pay for it. So let's assume that this purchase, we paid for it, and it came with discount terms. So let's say that that $1,000 worth of merchandise, we bought it, it had terms of 210 net 30, so we paid within 10 days. So what we're going to see here when we pay is, first of all, we're going to debit accounts payable for the $1,000 because we don't owe it anymore. We bought back here on this slide, we bought the inventory, we have accounts payable sitting there, it's a liability, so now when we go to pay it off, we've got to wipe out accounts payable by debiting it, so we're going to get the $1,000 out of here. And then we're going to credit inventory, and we want to credit, we don't credit inventory, I meant to update that. Well, I'm going to go through the whole, and that's actually purchase discount there, or inventory discount. The amount of that is $20. Okay, so, and I'm going to correct that as soon as I get this last one on here. Okay, we'll credit cash for $980. This credit here is going to be typically, more typically, is going to be to purchase this purchase discount. Oh, this is terrible. Okay. Well, here, you can just explain it. Is that a C here? Okay. I'm waiting for Blackboard Collaborate to come out with an iPad delivery system. Yeah. Well, I guess it's in the works, but it'll probably be a year till we see it. Okay, so that says purchase discount, my very awkward writing there. So we would debit account payable for the full 1,000. We're going to credit purchase discount for 20, and then credit cash for 980. And then we have one more journal entry, very, very easy. So we've done where we purchased it on account, we've done where we paid it off with a discount, and our last entry is going to be, what if we purchase it and we want to return it? We don't want it. So our next one, the journal entry to record the purchase return of merchandise that cost $500, we're going to be debiting accounts payable, and we're going to be crediting inventory. So all you're doing is, and typically, I'm going to do this here. Typically, that's not going to be a direct credit to, let me change that to purchase returns. That's probably a better answer. Okay. Or credit inventory. Let's leave it inventory or purchase returns. It's debatable. Okay, so now we're going to do a question, and you should be pretty good at this. This question should be pretty straightforward. Okay, an inventory system that uses computer software to keep a running record of inventory on hand is called what? A, periodic, B, perpetual, C, rolling, or D, current. Yeah. Mm-hmm. Can you restart your device? Because I've still got internet. I think we still do, right? What? Yeah. Yeah. And you've got internet beside her? Yeah, I'm getting a yes in the corner, yeah. What's your name? Haley, listen for this. Okay, I'm going to close this in about 5 seconds. Pardon me? Oh, wow, nice friend there. Did you get answered? This isn't going to mess him up, right? Okay. Wow, okay. Well, restart your device. We can take care of you, Megan. But, okay, okay. Okay, did you close this one? Perpetual inventory system. Okay, perpetual inventory system. Rolling or running total, it's going to be perpetual inventory system. Okay, next, we're going to talk about more about the different inventory methods. The inventory cost, we had the slide before, the purchases plus freight in, minus the purchase returns, allowances, and discounts. It also includes any cost to get it ready for use. So it's going to be so if you have to do anything like repackage it, if you have to pay any taxes on it or import duties, those are all going to be part of it as well. Okay, so we had 4 inventory methods for cost flows. What companies pick is up to them based on their goals. It does not have to match the physical flow of inventory. The only one that has requirements like that is specific unit or specific identification. This is used for unique items, typically that have serial numbers, pretty high-priced ones, usually. And you can only use specific identification if you can individually identify each of your inventory items. Okay. Now, this next one is the average cost. It could be the, I'm going to, okay. Okay, so we have specific unit and then we have average cost. This is weighted average cost. We only use weighted average cost. If we say average cost, it means the same thing as weighted average. This will be our total cost of goods available. So where are goods available? They come from beginning inventory plus purchases. Okay, so that's important to note. Beginning inventory plus purchases. This goes back to that formula back in the beginning of class where we said, okay, we have beginning inventory plus purchases equals the total available for sale. That's what I'm talking about. The beginning inventory plus the purchases is the total cost available. And then we divide it by the total units available. How many units did we have available to sell? They had to come from one of two places, beginning inventory or purchases. So we add those together. So to get our weighted average cost, we are going to take the total cost of goods available for sale divided by the total units available. I cannot stress this enough. This is one of those things I should be putting blinking lights on it going, this sounds like a question that's coming up maybe. Okay? So your total cost available, beginning inventory plus purchase, those are the dollars. You're going to divide it by the total units available, which is how many units were in beginning inventory plus how many units were in purchased. Okay, the next inventory method that we talked about was FIFO, first in, first out. So that under FIFO, the oldest units are the units we sell first. And then we have LIFO, which the last in are the first sold, so we're selling our most current stuff all the time. And again, which method we pick, we can't pick specific unit unless we have units that have serial numbers that we can track individually. So other than those last three methods, we have the choice of average cost, FIFO, and LIFO. We'll talk a little bit today, coming up here, about why we might pick one over the other. Again, make sure average cost, weighted average cost, you know, total cost available is the beginning inventory cost plus the purchase cost divided by the number of units in beginning inventory plus the number of units purchased. Okay, one more. This is very helpful. This is something I would memorize, okay? Under FIFO, our oldest units are in expense, cost of goods sold, and under FIFO, our newest units are our beginning inventory assets. So assets are on the balance sheet, cost of goods sold in inventory. We're going to talk about this coming up again. Under LIFO, our newest units are in cost of goods sold, the expense, and our oldest units are in ending inventory balance sheet. Okay, so this is a nice little summary. We'll probably see a question at some point related to this item here. In fact, guaranteed you're going to see a question coming up here on this a little bit. Maybe I'll add one more piece of information to this. Our cost of goods sold expense. This, of course, is our income statement, okay? Because expenses are on our income statement. Then the Okay, so what we see here is the oldest units are on the income statement under FIFO, the newest units are on the income statement under LIFO, And this makes sense. You can reason it your way through a little bit later in your accounting career. But right now, this is probably a good thing to have handy. It's probably a good thing to memorize. This would be one of those things that I would put on a flashcard and make sure I knew it. Okay? So now we have a question coming up. You should be able to get it. A company has beginning inventory of $40,000 and purchases during the year of $110,000. The beginning inventory consisted of 3,000 units and 7,000 units were purchased during the year. What's the average cost per unit, the weighted average cost per unit? And this question is in Learning Catalytics. Okay. I should have checked the notes back here. How are we doing on this? Yes. Okay, you want to be wrapping this up. We're going to be closing it soon here. Company has beginning inventory of 40,000, purchases during the year of 110,000. So you want to be remembering that your average cost is going to be your total cost of goods available divided by your total number of units available. We have beginning inventory of 3,000 units, 7,000 units purchased during the year. So about 10 more seconds. Close. Seeing a few answers straggle in here. I think we've got all we're going to get. Okay. Okay, close it. Okay, and the answer is $15. That would have been your beginning inventory of 40,000 plus the purchases during the year, 110,000, divided by the total number of units available, the 3,000 plus the 7,000. Now, what we're going to do is we're going to talk about, so we have LIFO and we have FIFO. These are two very opposite ends of the spectrum. Weighted average is going to be somewhere in between them. Specific units out there on its own because we can only use it if we have certain circumstances. So we're going to talk about FIFO and LIFO, and just know that weighted average is in the middle somewhere. So here's a thing to know before we have this discussion about the tax advantage of LIFO. You are required in the U.S. to use the same inventory method for your tax return as what's on your financial statements. So this is one of the cases where you have to match. Your inventory method on your annual report, what you give to investors, has to match how you report your income for IRS. That's done by the government for a specific reason. So when prices are rising. So we're going to walk through this. This is going to take a couple minutes to talk about the tax advantage of LIFO. Okay? So LIFO has a tax advantage. Sometimes we refer to it as the tax shield of LIFO. But LIFO has an advantage taxes when prices are increasing. So we know that over time, generally we have inflation. Okay, so every year there's what, 2% inflation, 3% inflation. So over time, prices creep up. Certainly some things go way up faster. Coffee and chocolate have been increasing. In any given scenario, we know that some prices will decrease. Electronics tend to fall in price. Gas fell in price for a while there. Now it's creeping back up. So when I talk about the tax advantage of LIFO, generally we're talking about this idea that inflation impacts companies. Companies will make their inventory choice and stick with it. And it's not all about the taxes. There are other reasons they choose them, but we're going to talk about the tax advantage of LIFO. So for most things, we experience price increases over time, inflation. So when prices increase, that results in lower taxable income. And why is that? I guess I should have an intermediate step. Under LIFO, we're using our most recent costs on our income statement. So our most recent costs on the income statement are the biggest, right? Because we're assuming costs are going up. So costs are going up. Under LIFO, my income statement has the most recent cost. Okay, so under LIFO as compared to FIFO, LIFO is going to have the biggest cost of goods sold. If I have the biggest cost of goods sold, that means my income's the lowest. Okay, because income is revenue minus expenses. If my cost of goods sold is big, then my net income is going to be the smallest. So under LIFO, it results in the lowest taxable income. Oh, I didn't say struggling. I said straggling. I'm sorry. I didn't mean to insult anyone. Okay, I'm going to talk about this again. Okay, but I just saw the thing. I didn't see people were struggling. I said they were straggling in. We were watching. We try not to close the questions when answers are still coming in. So we watched, and they were straggling in, not struggling. So, okay. So, anyways. So the tax advantage of LIFO. LIFO uses the most recent cost in cost of goods sold. Okay, so the most recent costs are in cost of goods sold, so that means our income is going to be the lowest under LIFO. So we have lowest taxable income. If we have the lowest taxable income, then we pay the lowest taxes. So then if we pay the lowest taxes, because we pay taxes with cash, that's going to give us the most cash, okay? So it has increased cash available. So LIFO, if we've got costs increasing and generally speaking, inflation makes costs creep up over time, LIFO is going to result in the lowest income and the lowest taxes paid, which gives us the most cash to work with. So all other things being equal, a company, if its costs are creeping up over time, it's going to prefer LIFO because it's going to lower its tax bill. Okay. Now, companies don't make a choice of inventory method just for tax purposes, but they can. That's certainly a consideration. So, but when they choose LIFO to minimize their taxes, they have to understand that when they report to investors, that income's also lower than it could be. But they disclose their inventory method to investors. So if I'm an investor and I know costs are increasing over time and I see a company's income who uses LIFO, I'm going to mentally know that under FIFO that income would be higher. So investors can do some adjustments for it as well. So LIFO has a tax advantage when costs are increasing. LIFO has a tax advantage. So why would anyone pick FIFO. Well, maybe they want to have the higher income figure to report. Again, companies don't pick FIFO and LIFO solely on taxes, but let's go through this. On LIFO is going to give us the more realistic net income figure. LIFO is going to give us the more realistic income statement. Okay. FIFO, on the other hand, is going to give us a more realistic balance sheet. So it depends what the company feels reports its picture better. You're not going to get both of them. You know, under LIFO, if costs are increasing, LIFO is going to give you a more realistic income statement. Under FIFO, it's going to give you a more realistic balance sheet. So companies weigh this. FIFO and LIFO, yes. I have friends that did that. They have cats, yeah. Yes. FIFO would give you an advantage if prices fall over time. Yeah. Yeah. Well, the thing is, you have to pick a method and stick with it. So you make your choice, and there you have it. Your book has a page on this, and that's worthwhile reading as well. So generally, we know that LIFO is going to give us an advantage in times of rising costs. We've had inflation historically every year, so on average, LIFO is going to give us a tax advantage. Okay, so LIFO is going to give us the more realistic income statement. FIFO is going to give us a more realistic balance sheet. There's also a reason companies might LIFO. LIFO saves companies taxes. Now, LIFO is only allowed in U.S. GAAP. If you're using international financial reporting standards, so your company has gone to IFRS or it's headquartered not in the U.S., you cannot use LIFO. LIFO is only allowed under U.S. GAAP. So LIFO is one of those differences, major differences between U.S. GAAP and international financial reporting standards. So you can't use LIFO. Also, every time they debate in Congress changing the tax code, if you read through their not every time, but most every time, they talk about outlawing LIFO. And the reason the U.S. government wants to outlaw LIFO is because if they all of a sudden told companies they couldn't use LIFO anymore, every company that's currently using LIFO that has had costs increasing over time, every company that's currently using LIFO is going to have a huge tax bill that year that they have to change because they're going to be releasing costs, they're going to be releasing low-cost inventory into cost of goods sold, and they're going to drive profits up. So the government wants to outlaw LIFO. It's a one-time revenue grab from the government because they would get a nice influx of cash if they outlaw LIFO. So eventually I think we're probably not going to have LIFO as an option anymore. But for right now, lots of companies do use LIFO. Okay, so yes, on Monday, someone asked what was an example of a company used LIFO or FIFO. Do companies really use this? Absolutely, they do. So I have two examples here. The first one is Target. So this is Target's 10K. So Target's 10K is going to, this is its statement of operations. That's its income statement. That's what Target calls its income statement. Okay. So Target's income statement, it starts with its credit card revenue, so revenues, and then it's going to subtract cost of goods sold. Target calls it cost of sales. So that's good. So we have revenues minus cost of sales and then other expenses after that. So the cost of sales for Target is its cost of goods sold. So what's in cost of sales? So we go to the note. There's going to be notes for the financial statements. The financial statements themselves only take 6 or 8 pages, but then there's probably 40 pages of notes after that. So the notes, I see a note about the cost of sales, and it tells me at Target the total cost of products sold includes freight expenses, inventory shrink, markdowns, payment term cash discounts, import costs. So it includes those costs, and it's telling you it's including that as the cost of its inventory in cost of sales. Then if we move on to Target's statement of financial position, which is Target's balance sheet, then we see that inventory is listed in the assets, current assets. First it has cash, then credit card receivables, and then inventory. So inventory is up there. And then we go to the note about inventory, and we see the inventory note for Target. It's every time if a company has inventory, it will have a note about inventory. So here's our note 10. The majority of our inventory is accounted for under the retail inventory accounting method using last in, first out, LIFO, okay? And then it says inventory stated at the lower of LIFO cost or market. That sentence relates to what we're going to talk about at the end of this class today, lower of cost or market. But Target uses LIFO. Okay, so that's what they're telling you in their note. They're using LIFO. Investors who analyze Target know that they're using LIFO. Okay, so then that was example of Target. So Target we know is using LIFO. So let's go on to Best Buy. So Best Buy, this is their most recent Form 10K. This is their statement of earnings, which is their income statement. And we look at their income statement, they have revenue, and the next item's down is cost of goods sold. So we look at cost of goods sold, and we see this includes freight expenses, cash discounts, cost of services, physical inventory losses, markdowns. So we have all kinds of things. They're telling you that they're including this as part of their cost of sales. Okay, that's what we saw in the chapter. So next up, their balance sheet. If I look at Best Buy's balance sheet, in the current asset section, they have cash, they have short-term investments. I think I've covered up receivables there. And then merchandise inventories are next. So since they have merchandise inventory, they have to have a note. So I'll go to the note, and I see merchandise inventories are recorded at the lower of cost using either average cost or first in, first out method or market. So that's got a couple statements in that first sentence. First of all, they're using lower of cost or market, which we're going to at the end of class today. So we'll see towards the end of class, we'll talk about lower of cost or market. But in there it says they're using average cost or FIFO. Okay, so Best Buy uses either average cost or FIFO. They don't get to point to something and say, we feel like using average cost on this one or FIFO. They have classes of inventory where they say, okay, for this class, maybe for all electronics, we're going to use average cost. Or this class, appliances, we're going to use FIFO. So Best Buy has decided to use average cost and or FIFO. It applies them based on inventory class, and they stick with that method. They do not change their method from period to period. They'll pick a method, they'll stick with it. You can pick a couple different methods, but you have to consistently apply them. So Best Buy is an example of a company that uses FIFO. So it's pretty easy to see. A lot of companies use LIFO for the tax benefits. Other ones have used FIFO. You can switch inventory methods, but you would only do it once in a great while. You have to have a reason. And when you switch inventory methods, you have to show the net income effect of that change. And that's a really, really long, cumbersome process to get to the net difference between FIFO and LIFO. So companies would not do that except if they were really committed to making that change in inventory method. Okay. Okay. Look back at your notes. Okay, just as a hint, let me go back to this. We have a question coming up in Learning Catalytics, and I want to go where I said this was really important back here. This is something I would, okay, here. Where's that little table? This thing, okay? You have that in your notes somewhere, okay? That's related to the question that we just sent out in Learning Catalytics, okay? If you use that table, you should be able to get that question. The FIFO method assigns the most recent inventory cost to expense. true or false? FIFO. Yeah, not only can the class see the chat, but it's recorded. Well, that's if Blackboard records it. Yeah. Making that assumption. Okay, FIFO method assigns the most recent inventory cost to expense, true or false? Okay, right now, as I'm looking at the answers that are submitted, a significant percentage have not answered correctly. Not a majority. Majority have gotten it. So you just want to make sure you're looking at the chart, okay, for this question, and you're looking at, now that I can't see the question anymore, but this is the part in your notes that applies to this question. We're going to be closing this question in about 10 seconds. Okay, the FIFO method assigns the most recent inventory cost to expense, true or false. Okay, good. So some of you answered again. That's good. We're pretty much done with people answering, I think. Okay. Okay, let's close it. Okay, that is false. FIFO assigns the oldest inventory cost to expense. Can we see that table one more time after the question? There we go, yeah, okay. And on the table that I had before, I had put income statement under with expense and balance sheet with asset. I just didn't have it on this one. Okay, we are going to go to Learning Objective 3. There we go. Okay, so Learning Objective 3, there's some stuff, you should probably look at the PowerPoint slides, read this section in your book. The thing that I want to call attention to, there's accounting principles relevant to inventory. Probably not worth memorizing. You might see a question here or there in homework or on the practice exam, but you can look that up. But this is not, we disclose our inventory principles. We want it to represent inconsistency. So again, that's not something I would worry too much about. This is what I want to worry about, lower of cost or market rule. This requires that inventory be reported in the financial statements at whichever is lower, inventory's historical cost or market value. And we abbreviate it, typically you'll see LCM, okay? And that refers to reporting inventory at the lower of the two. We don't report at the higher of the two. What we do is at the end of the period, we say, okay, our inventory has a cost of $200, what is the market value? If the market value is above 200, we don't worry, we don't do anything. But if the market value, if our inventories become obsolete or dated and it's not worth as much, we have to write it down. Okay, so the lower of cost or market rule means that we look at our inventory cost at the end of the period, we compare it to the market value, they call it current replacement value. What would it cost to replace our inventory? If that's lower than our cost, then we have to write the inventory down. The key here is we don't want to overstate our assets. We don't want to show an asset on our books that shows for higher than what it's worth. We want to be conservative. We want to show that the lower of the cost or market. Okay, now we are going to do short exercise 6-2. Short exercise 6-2, we're going to apply the average FIFO and LIFO methods. We've got 6 minutes left. I can get through most of this in 6 minutes. I will tell you right now, relax, I will send a video out of the whole thing. So if I go a little bit fast or we don't get it all, I'm sending a video out this afternoon, okay? So let's say City Copy Center sells laser printers and supplies. Assume that City Copy Center started the year with 100 containers of ink, average cost of $8.30 each, FIFO cost of $8.40 each, and LIFO cost of $8.10 each. So it's telling you, oh, here's these 3 different costs. They'll be different typically. During the year, City Copy Center purchased 700 containers of ink at $9.90 and sold 600 for $19.50 each, and then had operating expenses of $3,750, and we're told to prepare the income statement. So what we're doing here is we're preparing the income statement using average cost, and then preparing it using FIFO, and then preparing it using LIFO, and we can see the impact on the net income of doing this. Before we get to it, we need to calculate we need to go with how many units are in ending inventory and how we do that. Okay, what I've got in the lower half of the screen is common to all 3 methods. So these are number of units. Beginning inventory had 100 units in it. Purchased had 700 units. And then ending inventory is 200. How do I know my 200? I would take the beginning inventory plus the purchase minus the sold is 600. So that's where I got the 200. And then I come up with my sold. This is just exactly what we started class with the basic formulas of beginning inventory plus purchase minus ending inventory gives us sold. So this is in units. Units are not impacted by what inventory method you use. Okay, so that's common. That's going to be used for when we do average cost, FIFO, and LIFO, the units. So let's start with average cost. So it tells us that our average cost in beginning inventory was $8.30. Then it said our purchase was $9.90. And it doesn't matter which method we're using, our purchase is what we purchased it at. So once I have those 2 numbers, I can multiply. So I have 100 units at $8.30 according to the facts in the problem, and I have 700 units at $9.90, $6,930. So I get $7,760. That is my total cost of ending inventory plus my sold units. Okay? Now I'm looking to do an income statement, so I need my cost of goods sold. So that's $7,760, and we're doing average cost up at the top. I have average cost written. We're doing the average cost method. So now I want to get my average cost per unit. I'm going to take that total available for sale, the $7,760, divide it by the number of units I had available for sale. How many did I have in beginning inventory plus purchases? I had 100 plus 700, so I had 800. So if I take the 7,760, divide by 800, I'm going to get $9.70 as my weighted average cost per unit. I'm doing an income statement, so I need my cost of goods sold. My cost of goods sold will be, for the weighted average method, my cost of goods sold will be the number of units I sold, the 600 units, times that 970 cost. So I will get 5,820 as my cost of goods sold under the average method. Now, so what I've done is I've calculated cost of goods sold under the average method. The problem says to do an income statement. So our income statement is going to have the format like this. We'll have the name of the company first, the name of the statement, and the date for the year ended. Now, we have to do an income statement for average cost, FIFO, and LIFO, so we'll have a column for each of these. Companies would not do their income statement 3 ways. The point of this is to show that each way produces a different income. So what we're going to do is we can fill in the average column first, and we're just going to fill in FIFO and LIFO as we do those. So the average column is going to be sales revenue, 600 units sold times the 1950. That will be the same. Sales revenue doesn't change under inventory method, so we can fill in FIFO and LIFO. That doesn't change. Operating expenses are the same under all 3, so that's why I can fill it out. So next up, I can fill in my cost of goods sold. That 5,820 that we just calculated goes in cost of goods sold for average. I subtract that from sales revenue to get gross profit of 5,880. And then I subtract operating expenses to get net income. And I think that we could do FIFO. We are at the end of class. I will email out the rest of this. We'll just pick up where we left off. And I do have a couple other homework problems I'll email out to you. So have a nice weekend. Stay warm. I guess we're in for a cold snap again.